This is the BiggerPockets Podcast, show 220.
You're listening to BiggerPockets Radio, simplifying real estate for investors large and small. If you're here looking to learn about real estate investing without all the hype, you're in the right place. Stay tuned and be sure to join the millions of others who have benefited from BiggerPockets.com, your home for real estate investing online.
What's going on, everybody? This is Josh Dorkin, host of the BiggerPockets Podcast, here with my co-host, the man, the myth, the legend in his own mind, Mr. Brandon Turner.
Does that mean I'm a myth in my own mind as well?
You're everything in your own mind.
That's true. I'm the man, the myth, the legend, Brandon Turner. Thank you. How you doing, Josh?
I'm okay, man. Thanks for asking. You know, you never really do ask me how I'm doing.
That's because I don't really care. So it's easy. I just skip right over it. So
and yet I continue to bring you on the show.
It's weird, you know?
Whatever. It is weird. Glutton for punishment. I'm good. Thanks for asking. Life's all right. Was kind of sick last week. That was a bit unfortunate, but things are going well. You know, we just had 3 new people start BiggerPockets this week. In fact, so today we had somebody join us, and yesterday we had 2 new people. So it's been crazy. Just lots of change, lots of movement, lots of acceleration here at the company. Very exciting stuff.
Yeah, I haven't actually met any of them. I need to reach out to them via Skype today and you know, give them a virtual hug.
Yeah, you should do that.
Would they be creeped out if I give them a hug, like virtually, like just wrap my arms around the computer
whatever
screen?
you do creeps us all out.
People are used to it at this point. It's okay.
What, the creep factor?
Yeah.
Yeah. It's like that uncle who always touches you in a weird place. Wait, that's not me.
I don't
Is that everybody or just...
that might be just you and your weird uncles. All right, so I gotta tell you something. So I'm getting into this kind of this new real estate niche, sort of. I'm trying to buy something a little different, and I'll explain more maybe in the future.
Riches and niches.
Yeah, the riches and niches. So I'm working towards a new niche. What's fun about that is I feel like I'm a brand newbie again. Like I'm learning for the first time because like this is kind of new and exciting. So you know, anybody who's brand new to real estate, haven't bought your first property.
Today's show is brought to you by...
I'm just saying I'm with you. I get what it's like to be a newbie, you know, because I'm a total newbie when it comes to this niche. If you want to know more about that, come to BiggerPockets webinars. I talk about it usually there, BiggerPockets.com/webinar. But with that, speaking of webinars, I don't really have anything to say about that. But why don't we get to today's quick tip? All right, so today's quick tip. So this has nothing to do with webinars other than that there was video. So our quick tip today is, you know, we've been doing a lot more video content here on BiggerPockets and some really, really high quality stuff. In fact, Josh is, what is he, your nephew? Is that right? Zach is incredible at video, and he's been doing a ton of stuff with video. Anyway, we've been doing like actual walkthroughs of properties and all these other cool things, and we were putting them out on 2 places. We're putting them on our Facebook wall. We're doing Facebook Live. If you go to facebook.com/BiggerPockets, make sure you're following us there, and you can
watch them live and ask questions on the fly, which is really cool.
Very, very cool. Yeah, and then we usually take them, not always, but usually take them and we download them and we put them on YouTube as well later. So make sure you're subscribed to our YouTube channel, which is, of course, youtube.com/BiggerPockets.
Check it out. Check it out. Cool. Awesome. So we've got a great show today. Again, this is show 220 of the BiggerPockets Podcast. You can check out the show notes at BiggerPockets.com/show 220. Also, of course, we would love it if you have not yet subscribed to us on iTunes, Stitcher, SoundCloud, wherever else you are listening or watching. Please do go and hit the subscribe button. And if you can, leave us a rating and review. We do always love that. All right, guys. So today's guest is Jesse Fragale. Jesse is a real estate investor who has focused on college rentals for the first part of his career. And then he actually ended up transitioning into a larger multifamily, just closed on an 11-unit property. He's also a commercial real estate agent focused on leasing out properties. So really smart guy. He's got some fantastic wisdom and a good guy overall. So let's pay attention. Let's give him some respect. Let's bring him in.
Like respect, like the respect you gave him during the recording.
What? I'm sorry. Yeah. I was trying to introduce him.
Yeah. You know, we'll see how respectful you are when you bring him in. All right.
I'm extremely respectful.
All right, let's bring him in. Jesse, welcome to the show.
Hold on. Before we bring him in, let's talk about this. It seems like you got a bit of a problem here.
No, I got no problem.
Do you have a problem? I mean, do we have an issue?
I'm just saying you made some funny jokes at Jesse's expense today.
Don't I always make funny jokes?
You usually make jokes at my expense. Today, you railed on Jesse a little bit. Not a bad thing.
Jesse and I are friends.
You guys are BFFs.
It's love between friends. Yeah.
You watch your soap operas together and stuff. I know.
Can we bring him in? I don't need this animosity here, Brandon.
You bring him in. Do it.
All right, guys. Let's bring him in. This is Jesse.
Good to be here.
Good. So, Jesse, tell us a little bit about yourself. Where are you from? Where are you doing this real estate thing from? And then how did you get into it?
Okay. Well, actually, first, I just want to say that every time, Josh, you get on the show and you get the BiggerPockets Podcast intro, it gets me going, man. It fires me up.
Me too.
This is Jesse Fragale on the BiggerPockets Podcast. I know I butchered it, but it's all good.
Fragale, it's all right. It's a Sicilian name. It's not the easiest one.
Don't kill me.
Will not. Brandon, just a bit of the background for me is I started investing in real estate in Toronto. I live out in downtown Toronto area, but the way I got into it, you always hear about guys or some reason to get into something was because of a girl. Well, I was too young for that at the time. It was all because of a car. And a very specific car. It was a 1999 Viper RT Cherry Red with the big old V10 engine in it. Fancy. So just give you guys some context. So my family is, my father is a mechanic by trade. And so are his two brothers. They came from Italy. The whole family came down here and started an automotive company, basically a garage. So I'm a really big car guy. And when I was growing up, my dad had a really cool younger friend, about 10 years his junior, that was a real estate investor. And he would invest in single family. And I think, Brandon, correct me if I'm wrong, you're at about 50 units, I think, from the last show that.
Yeah, I think
Stalker alert.
52 or something like that.
What's going on? What?
So this guy, his name was Mikey. He had about 30 units. And when I was about, I think it was 10 years old, I saw this Viper. And I think back then they MSRP'd at over 100,000. It's on my driveway. And I was like, whoa. I'm like, that is the coolest car. And even to this day, I mean, it's kept up with the times. And I went to my mom, I think at the time, and I was like, what does that guy do? What is because everybody has their vision of what success is when they're young. And to me, that was it. And she told me, well, Mikey invests in real estate and the stock market. And I started asking questions. And anyways, throughout from there to when I got my first deal, I started reading books like, Kiyosaki's books on business and real estate books in general. And then I made my first purchase when I was in university. And it was a student rental property on William Street out in a suburb or a city just west of Toronto, called Waterloo.
Okay.
Wow. So you were inspired by Mikey.
Mikey.
This college investor because he had a rad car.
He had a red car and he had 30 rental units. So what basically she said was he invested in real estate. And that was really interesting to me at the time. And I didn't understand what that meant.
Sure.
And as I got older, I started to realize what he did was single family homes investing, and built up a portfolio. He was 20. He would have been about my age now. And he was in his late 20s and he had built a portfolio of about 30 and change. And whatever impact that had at, being that young and seeing that kind of car, and not that success is defined by a car, but I think as a little kid, that was big.
That's all good.
I think that's cool. So did you ever buy the car? No, we're skipping way ahead, but
that's
you know what? I bought a very different car last year because I'm a big tuner guy. I bought a 1985 Porsche Carrera when they brought the Carrera name back. So that's my little project.
Nice.
That's pretty cool.
All right, so tell us about the student rental.
Yeah, go for it.
What was that?
Okay, so the student rental, I was living in a property when I was in school there with my buddy, and he was house hacking it while in school. So he had 4 of us paying him to live there.
Nice.
And I'm sure you've heard this story before. I was like, why am I paying this guy? Why am I paying my buddy for his place? And it kind of inspired me to look for places down there. And one of the benefits of being a child of divorce is that, when you get a bad answer from your father to invest, you can always turn over and be like, hey, Ma. So what happened, and I just want to say my parents are both very entrepreneurial people in general, but my dad, rightly so. At the time, I think I saved up maybe 25, 30,000 by the time I was 19, 20. I was working construction in the summers. And he said, basically, oh, I like the idea. The answer is no, because you have no money. You're playing sports in school and there's no income. So I tried that on for size, talking to my mother, and she was able to co-sign. And so at the time, if I remember correctly, I know everybody, including myself, are always interested in numbers. I think at the time it was 10% down, and it was going for about $250,000 the property. But the issue wasn't the cash down; it was more getting the guarantor, getting somebody to sign off for you. And so I got 5 female Waterloo students that were already pre-existing leases, a little bit under market. But now I was supposed to be this guy that's pretending I'm 10 years older than the students. Meanwhile, I'm at the university a couple kilometers, couple miles down the street.
So you didn't actually live in the property, then you just bought it as a rental, purely as a rental?
Yeah. So what ended up happening is that because I signed I think it was a 1 or 2 year lease with the guy I was with, I didn't want to leave him high and dry. And I assumed the property with 5 tenants currently living there. So I decided to do that. And then that kind of, that led to the next kind of investments I slowly made.
What kind of rents were you getting from these 5 female students?
So the house was renting for just under $2,400 per month.
Okay.
And so, back then, I don't know if you guys, if you've seen our market, it'd probably be most comparable in the States to Denver, New York, San Francisco. It is extremely tight. Yep. My background is a broker by trade, but I work in commercial real estate. And I mean, the cap rate compression that we've seen is just incredible. Your stuff is going, pretty significant property is traded below a 3% cap, which is is pretty insane.
That's nuts.
So
who's buying that?
Yeah,
we'll come back to that.
Yeah, no problem.
Okay. So, let's go to your story and then we'll dig in there. So, I don't know much about you. So, since that point, I mean, what have you done? What's your thing? What do you do?
Hey, Brandon, way to admit that you don't prepare. That's great. At least you're honest.
I do it on purpose. I want to be revealed when I.
Oh, is that right?
Yeah, I want to be surprised. So, Jesse, surprise me. What do you do?
He knows talking to a Canadian, I'd be a nice guy and forgive him.
Exactly.
Sorry, I just cut you off there. You said, what did you do? What do you do?
Yeah, what do you do? Tell your story.
Since then, I've moved from student rentals. Basically from that, I rolled that into another property a couple of years. Just for context, I was 2008, I think was the first rental. So you guys felt the recession obviously much more than we did, but there were still depressed prices here. So with that appreciation, I was able to get into a few more units. I got up to the point where I was at, I think 35 beds. So that was 35 students by the time I was leaving university. And then I started working full-time in Toronto. And what I started to realize was that the property management piece for student rental properties, as I'm sure a lot of the listeners know, it's a big component, and you need a very solid property manager if you're not going to be in town. And I was kind of getting tired of having properties where the maintenance and upkeep and the capital expenditures were significantly higher than, say, for instance, like you, Brandon, a single family home, or where I want it to be, which is multi-residential. I wanted to get into apartment buildings. So since then, I bought, I think, 3 or 4 more student rentals. Then I switched into, these are fairly popular here, student condos. So student rental condos. And what we do here, because the market allows it, is that they give you a 2-year free property management and a 2-year rental guarantee. And the thing that's interesting with that is, or the one thing that people really like, is the fact that there's no upkeep. So long story short, I went from there, and I'm proud to say I know when I was talking to Alexandra on BiggerPockets just prior to this, I think I was in negotiations for my first apartment building, and we closed about 6 days ago.
Oh, nice.
So
congrats.
So we're pretty excited about it.
That was an 11 unit, wasn't it?
Yeah, that was an 11 unit.
Somebody's doing their homework.
Josh is doing homework.
Wow. Okay, so you went from the student housing to the student condos, and the next step was this big multi that you bought, the 11 unit.
Yeah, that's right. So what I saw was that I'm sure anybody who's been in real estate long enough, you understand that at least I see 4 ways that you make money out of real estate, and why it's so attractive. Number 1 is cash flow. Number 2 is either forced appreciation if you can do it. Commercial is a little bit more like that, or appreciation in general. We don't bank on it. I think, as you guys usually say on the show as well. And then the last two, I feel people kind of, they forget about until they sell or get into real estate. And that's the tax advantages of real estate. And then that's the tax advantages to having real estate, what you can do with your income. But the last one is, not until you sell do you realize how much principal you're paying down.
Yep.
And while we all love capital gains, I mean, profit's awesome. You pay taxes on it. And as I started to sell my student rentals, I wanted to position myself to start doing apartments, to start pooling some money. And you realize that you paid down the principal that amount, so that what you're taking out is the capital gains piece, but really that forced savings plan that now allows you to go do something else. Yep. And just briefly, one thing that's a lot of Canadian investors are really envious of in the States is the 1031 exchange you guys have. That's not a thing here. And that has implications for the fact that we just don't trade real estate as much as you guys.
Just for those people who don't know, a 1031 exchange, what he's talking about there is where in America, we can take properties. Let's say you sell your property for, and of course, I'm not a CPA, I'm not giving legal or tax advice here, but you can sell a property and then buy another one within a short time frame. Usually I think it's like 6 months, and you don't have to pay taxes on the sale you just did. You defer the taxes further down the road. And some people will just keep doing that over and over and over their whole life. And then when they pass away or the kids inherit the property, though, all those taxes just kind of disappear. It's one of the greatest benefits, of being in real estate. You can really, it's basically you're partnering. I like to look at it as you're partnering with the IRS. They're like, IRS is like, hey, you did a pretty good job on that property. Just keep our money a little longer and put it in the next deal. You can buy something bigger and then pay us to then. Like the IRS, it's a pretty nice benefit there. So. But anyway, I like that you broke that down. I call those like the 4 wealth generators, like cash flow, appreciation, the tax advantages, and the principal getting paid down. And every real estate deal pretty much has 1, 2, 3, or 4 of those mixed in there. And some are, I talked to a guy the other day who was wanting to buy a rental house, but he was talking about this rental house and he'd have he was paying over market for it. There was zero cash flow. He'd be losing money on it. I'm talking to him about it and I'm like, this is just a terrible deal. Don't do it. But the more I talked to him about it, the more I realized, well, in his position, the tax advantages and the principal pay down, and potential appreciation because it was in Southern California, maybe could make it up for it. Like I wouldn't recommend a newbie doing it, but every deal's got those somehow. You just got to figure out where they're at.
Yeah. And you know what, there's one that I always say, because a lot of the books, if you've read real estate books for a number of years, those always come up. The 5th one for me is the one, I'm a really big behavioral economics, behavioral finance. It's behavioral sciences in general. I think the last few years, there's been a lot of books on this. And the one for me is that there's a book that recently came out. I think it was kind of a play on The Wealthy Barber. It's called The Wealthy Renter. I don't know if you guys have heard of it. And it's basically talked about why renting is in a lot of ways better than owning. And they were talking about principal residence here. And so stuff, Grant Cardone always talks about this, your principal residence, you have mobility. But what's interesting is that when you actually break down that, okay, say you're renting and then you can make this amount of money that, you could save by not owning for some reason, in some theoretical situation, you would position that money to do something else like invest. But the psychology is a little different because once we have that $300, where does it go? Oftentimes it's nowhere. It's just gone. Yep. And I think the discipline that real estate affords people is that because it's so illiquid, you can't access your money very easily. So sometimes you're a little bit more rational. You kind of sit back, you can't pull money out of it, and you pay into this savings plan that you've kind of created.
Yep. And that's actually how I look at bad deals. Like I have a few houses that lose a little bit of money, maybe break even. And I'm like, you know what? Worst case scenario, it's forcing me every month to save a few $100 because my principal is going down every month. My tenants are paying my principal down. I've owned the properties for 10 years now, and worst case, that's what it does. So
it's not just the principal pay down, but over time, that principal pay down means your rents are obviously going to go up, right? So ultimately, once you've paid that note off, if you're going to hold on to the properties, now your income's going to jump. Yeah. So. Yeah. It works.
Yeah. As I say, I love that psychological thing there. People don't, if they had an extra few $100s a month, they're not going to invest it in something else. Most likely they're going to buy a nicer pair of shoes or a nicer TV or whatever. But by having that house, when you actually own the property, it forces you to. So I think that's smart. All right. So let's go back a little bit and talk about the managing
the student rentals.
Yeah. The student rentals a little bit. Cause that would be, that 35, what did you say? 35 unit or tenants, 35 beds. What's that like? I mean, how do you do that? How do you manage that? Did you have a manager? Or?
I needed one by the end of it. So when I went into university, I was playing football at the school I went to. I was probably more social than when I really started having to kind of manage the properties. I think there was a tipping point. 20. You got to think of these about 5 or 6 students per unit, right? So I think there was a tipping point about 3 properties that it was too much to manage while in school, and that's why I actually ended up leaving 1 year early, finishing my degree by commuting and working in Toronto, just because it was just something that you needed that safety net at that point. One story, I mean, you really do earn your stripes with student rental, especially when things go wrong. And one of the big things was that third property that I purchased, there was water damage. I think it was about 3 or 4 months after I purchased it. There was significant water damage, and what it did was it caused quite a bit of mold in the basement. Oh. And I remember hearing, I remember talking to the construction guys after and to figure out what the extent of the mold was. And I remember this. It was literally the worst day of my life when I heard that figure, and it was $13,000 to fix it, and it was $8,000 to get everything to remediate. Sorry, $13,000 to remediate, another $8,000 for construction. And 22-year-olds, like a bag of bricks. I was just whoa. Know when you've just been punched in the gut.
Yep.
That was the feeling. And luckily I had kept all my profit within the company, so I was just barely able to cover that.
Did insurance?
There was no insurance. Yeah.
So because it wasn't a flood. They said basically I went back and forth with the insurance companies on the extent of the damage and the reason for it being caused. And for whatever the circumstances, this is going back years now. Trust me, I fought it as hard as I could, but wow. You know how it is. It was just and that's why I think real estate, if I ever have a kid, a girl or a boy, I will definitely say to them, own a rental property for a certain time in your life. Because when I started in university, I was doing the flooring. I was, there being the guy doing all the stuff and learning, and then outsourcing what you didn't know. But I think it does build a lot of character having these properties. So anyways, to answer your question, I stuck with the student stuff. And then in my last year of school, I went to a property manager that specializes in student rentals. There's a lot of them in the university towns, and they basically took it over. And you pay a little bit, but if it's a good manager, they save you the aggravation.
Yeah. And that's why we always talk to people about factoring in property management when you buy a property. Lots of people say, well, I'm going to manage it. I got this. This is easy. And it's all good. Well, guess what? It's all good until you're no longer wanting to manage your own properties, and then you have to pay somebody. And if you didn't account for that, all of a sudden what was a cash flowing property is no longer a cash flowing property. So, it's hopefully you weren't in the red after you took on property management.
No, that's the one nice thing with student rentals.
Stack more kids in there.
Yeah, you could stack more kids in there. It's all licensed. It's all licensed stuff. That's the reality. Is you're going to spend a little more on that stuff, but the cash flow is a little bit. It's a little higher.
Awesome.
That makes sense.
Cool.
And just a couple of quick things to ask you about. First of all, a good tip you mentioned in there, just like a tip to draw out of what you said. Talk to your insurance agent, people. Like if you got rentals, talk to your insurance agent, find out what's covered, what's not. Because it'd be miserable if you have a $20,000 thing. It's another reason why a lot of times people buy rentals and they think that they're cash flowing, really well, and then they're hit with a big expense. And there goes, I had the house that burned down a year and a half ago, whatever it was. Not burned all the way down, but they burned the kitchen, right? Insurance covered majority of all that, but the tenant, I still evicted him. It was in the process of eviction that it got burned down, and at the end of the day, I ended up losing $15,000. Out of my own pocket on that deal. I looked at the cash flow, everything I'd saved up for the past 10 years, it was $15,000. In other words, that one event killed my entire profit for 10 years on that properity. Just like that.
Yeah, that's crazy. Yeah, that was the property that we were hanging out at the lounge when you got the text.
When I got the text,
I might have burned your house down, Brandon.
Yeah. You need to call me your house. Yeah.
It's funny you mentioned that, because one of the impetus for myself to move into apartments was the idea that it's not a perfect science, right? It's a bit of an art and a bit of science when you're trying to estimate how much you should put away for capital expenditures. We typically think, our market is $250 $250 a unit as a capital expenditure, and then for R&M we use $750 for repair and maintenance.
Okay.
And when you scale up these properties to 50 units, 100 units, then it starts becoming more of a science. But when you only have 3 or 4, to your point, when you think you're cash flowing, then you get hit with that big, furnace or the big roof, and then it just wipes you out in terms of that year's cash flow.
Yeah. Well, actually, funny on that note, a year ago, the house was fixed up, right? So then it was done. It was cash flowing again. We're getting about $250 a month in cash flow, and so over the last year now, we've kept a couple, I think $3,000. The furnace went out last week or 2 weeks ago. They're shot, gone, no furnace anymore. Guess the bill was $3,500 for a new furnace. There goes last year's cash. Because that's why people think they're buying properties that cash flow, and at the end of the day, they're really not. Because
they're not.
Yeah, CapEx, the capital expenditures will eat you alive if you don't budget for that kind of stuff. So.
Well, so let's repeat that one last time for everybody, because you can't understate this. Seriously, if you're a new real estate investor and you're looking at a property and you're not accounting for what we talked about earlier, property management, if we're not accounting for what we just talked about, capital expenditures, repairs and maintenance, and the one that we haven't actually talked about, vacancy rate.
Yep.
If you're not accounting for that stuff, and you're like, oh, well, mortgage minus taxes, insurance, I got cash flow.
Yeah, this is great.
Yeah. Not how it works, guys. And that's the fast way to lose your shirt.
Yeah, and that's kind of the thing where if you're looking for a property and you talk to a broker, and who are you getting the financials from? You getting it from the broker, the seller, or the vendor, right? Yep. And everybody has a different take on what they give you. So we'll see a lot of deals that come in that are apartment deals, and these are actuals. There was nothing here in terms of maintenance, so we didn't put anything down. It's like, well, that's not the way it works.
Yep.
Yeah,
yep.
For sure. Hey, so before we move on to asking you some questions about, actually, Brandon, I know you've got a question. I apologize.
You should apologize, Josh.
You know what? I'm going to just take this question. So, Jesse, do you recommend student rentals as a good way to start?
You know what? It's a tough question. You definitely, like I said, you earn your stripes. It is. I'll tell you this. I'll tell you some of the advantages of student rentals is that with student rentals, they're seen as high risk investments, but typically they're in university towns and they're guaranteed by their parents, right? The other piece is, and this is more specific to myself or anybody listeners that are in a market that has rent control. Because the tenants are there for only a year or two, maybe 3 max. In our market, it's only when a tenant leaves that you could bring the rent back up. So you're stuck at basically what they call the RTA. It's basically you only have a certain percent. You can raise it every year. I think this year it's 2%. Right. So until that
is that everywhere in Canada, by the way, or is that?
So yeah, I'm in Ontario, in Toronto. So that's the Ontario Landlord Tenant Board. But across Canada, every tenant board has different rules.
Yeah.
But it is a challenge, right? And that's another reason that you see in these markets, you see a lot more buy and holds. I'm pretty sure New York, I'm not an expert. Yeah, that you're going to have that kind of situation. So that's one of the benefits is that you'll always be pretty much at market value with student rentals if you're in one of those environments. If you're not, maybe it's not the best. But as a first purchase, you know what? I think being a 20-year-old guy, I would have rather deal with 5 student renters than maybe dealing with a 38-year-old single family house where he's like, who's this kid? Who's my landlord? I don't know. There's a bit of a situation there. But I think the important thing is if you have an opportunity to get in to real estate, if the opportunity is student rental as opposed to not getting in the market, I would say take it on.
Cool. Awesome. All right. So now, before we move on and talk about this 11-unit property you just closed on, let's go to today's random You gonna help me with that, Brandon?
Random 5.
Random 5.
Is that our sound effect? Right. I don't know. We don't have one yet.
I don't know. We need something in there. All right. So the Random 5 is a new section of the show where we break from the real estate and get to know our guest on a more of a personal level with 5 random questions.
A personal level? Are we getting deep?
This is it, man. This is. Hold on. Get on the couch. Lay back. All right. Here we go. First question for the Random 5. Jesse.
Yes, sir.
What movie could you see again and again and again?
It's not even hard. I could see Terminator 2 for the rest of the time.
Nice.
Good choice.
Wasn't that rated like on like the IMDb or whatever, or Rotten Tomatoes, like the #1 movie of all time? I think it was that one in Toy Story too. Like
Interesting.
Those two are like the highest.
I mean, I have to say, just be Italian background. I got the Godfather. I could probably loop. Maybe not the third one, but I could probably loop those for.
Nice.
Nice. All right, Mike. Next one. What is the most important skill to have in school?
In school?
Yeah.
Oh, geez. I would say for school, time management. I think being able to, one of the big things with school, at least from my experience, is you're kind of overwhelmed when you're coming from high school to university. I think time management's, portion in that. And I think that goes for any of us, in the real estate world.
Cool.
Nice. All right. How long before your flight do you arrive at the airport?
2 hours.
Always.
If I can, depending on what's happened the night before.
Okay.
All right.
Nice.
Do you watch the Super Bowl for the game or the commercials?
You got to watch it for the game. It's either honestly, it's funny. I've played hockey and football growing up my whole life, and all my friends are huge sports guys. And it sounded like Donald Trump there. Huge. Sorry.
Huge.
Huge. But I mean, it always bought one thing that's funny. Last time the guys were here, the Super Bowl, it goes to halftime. We take out the Xbox, and the girls started freaking out. Apparently, we weren't in the know that's not cool. So we had to watch through the halftime stuff.
Nice.
All right, last question. What's the worst pickup line you've ever heard?
The worst pickup line, Jesus. That's a tough one. I don't know. I'm drawing a blank on that.
All right, what's the worst pickup line you've ever given?
You come here often?
No. Oh, man.
Going for the classic.
Jeez, just by that, you can tell it's the worst.
Awesome. Oh, thank you for joining us for the Random 5. Hopefully, it gives our listeners, a little more insight into your head there.
That's dangerous.
Yeah, for sure. All right, so let's get to this property you just closed on. You said it was an 11-unit property. Talk to us about why'd you make the leap into larger apartments, and what was kind of the mindset? What was going through your head? Were you scared? I mean, talk a little bit about that.
Yeah, sure. I think after selling a few more of these properties, I was, ready to put money into an investment. I was a little over the student rental game. I'd done it for a number of years, and I wanted to have scalable assets. And part of it, honestly, your show, you guys had Jake and Gino on at Wheelbarrow Profits, which I mean those guys. Awesome show. Great information. I mean, sometimes you guys ever watch the podcast where you press the 1 times or 2 times and the words go really quickly. And I'm listening to Gino, and he's so on. Sometimes I'll be like, "Is he speak?" No, that's regular time. He's just so much information just coming in.
Cranking.
So yeah, absolutely. So I think like a lot of people's journey with real estate is you start off by podcast, books, and that's what turned me to apartment. And then a friend of mine at my brokerage. Now, I specialize as a broker in office, and my buddy John, who I partnered with on this deal, he's a VP in our apartments group. So he sees these big 20, 30 million, 40 million deals, deals that we'd love to have, years down the line. And he sees the ones that, don't are too small for us to deal with. And we were talking, and he said, "Have you ever considered investing in apartment buildings?" And that's kind of what got this conversation going, that, okay, well, how much will we need? You need this much and I need that. What's the process? And what I found is that people are afraid, or they're a little apprehensive with apartments because they feel they're these big deals that they could never do. And I remember early on somebody telling me the bigger the deal, the easier it is to do. And that's not a general rule. But with apartments, the one nice thing is that I probably could have got accepted for this apartment easier than for a single family house that I would live in, because the rules for apartments are commercial rules. If they're over, 4 units, is that the building is the critical piece, not just the individual. The individual definitely matters. But I mean, at a certain point, when you're buying $30, $40 million, $100 million apartments, how much are they going to care that you make $200,000 a year or 500? You'd have to make, that's just not the way they value them. So anyways, that shift in thinking, and Gino on the wheelbarrow, limiting beliefs, that's a constant theme with them, is that you kind of break out of that idea and you start realizing that, wow, I could buy this. It's just a matter of how to structure the deal. And I think Brandon, in one of your books, is just mentioning that a lot of times it's people think it's the money that deals don't get done. It's almost never the money. If people's back are up against the wall, whether that's syndication or single family house, you can usually figure out that piece, the money piece, if it's a good deal.
Yeah,
makes sense. Yeah. So you decide that you're going to get into larger multifamily. You have this friend who's at the company who says he's going to look for stuff for you. How many properties did you have to look at before you found this thing?
Oh man, back of napkin. Like you guys know how it is, right? Like even the 50% rule, which is people think that 50% rule, or I hear a lot of people like that's a lot, to take off the top. It's like, yeah, just wait. 50, 60% is a good rule of thumb when you're actually looking at these properties. Yeah. I'd be guessing, but it's definitely over 30 properties. Nice. Right? That you quickly do an analysis, and that's not going to work. That's not, and not to mention our market here. It's Josh. I'm sure in Denver it's the same way. It's just a tight market. It's crazy. You can't find anything.
Hey, real quick. Can you explain 50% rule for those who don't know what that is?
Yeah, sure. So from our perspective, when we're looking at net operating income, you're basically dividing your gross income in half to arrive at your NOI. And what we do is, if anybody's familiar with cap rates, which is the yield on properties, is that if you divide, so if you take, say, for instance, you have $100,000 in gross income, you divide it in half to 50,000. You divide that 50,000 by whatever your prevailing cap rate in your market is to arrive at a value, a building value.
Let's do an example of that so people, in case they're confused with that. So, I mean, you use that number 100, would you say, like, let's say $100,000 a year is your gross income.
Yeah, well, it's for simplicity. Let's say 200,000 is gross income. Divide that in half. You're at 100,000. Okay. Right? And you divide that at...
And what is that half? The half is what your estimated expenses are going to be, correct? That's
exactly.
50%.
Yeah.
Now, and also your NOI then, what's left over, not counting the mortgage, Right.
Exactly. Okay. Yeah. What we call in commercial above the line, right? Anything below that was when you start putting into capital expenditures. Anyway, so you're at $100,000 net operating income. Now you divide that by whatever the prevailing cap rate is in your market. So if your market is seeing, I don't know what you guys are seeing in your markets, where 5, we'd be happy to get 5s.
I'm looking at like 8-ish. Josh is probably at like, I don't know Denver,
6.
But 5 or 6. Yeah.
I think you're sitting right around 6s.
Yeah. So you divide 100 by 5%, and you're at a $2.5 million valuation on those, right?
Maybe. Yeah.
100 divided by 5.
Oh, sorry, 2 million.
2 million. Yeah. I'm trying to do the math in my head. Yeah. Because you're multiplying.
You know why it's so hard for you guys? Because you're like, what the hell is a 5% cap rate?
It's very confusing. What's a 3? You said what?
So $100,000 divided by 0.05, a person's going to get $2 million, and that's generally the value. And that's why we love apartments, right? Because now you decrease your expenses or increase your income a little bit, and it multiplies that significantly, right? So.
Yeah, and now, just not to get too technical, but when you're looking at pro formas, because a lot of the guys that do apartments, they're private equity guys, or in the States. We don't have the yields to sustain this here, but there's a lot of syndication in the States, which is basically pooling people's money, having a general partner, as you guys know, but for anybody that doesn't, having a general partner who is the asset manager, finds the deal, and then having the limited partner, who are people that want to invest but only want to lose what they've put in. And so that syndication model is you'd actually have running a return for these guys. And what you would typically do is you would look at what your outgoing cap rate is. And your outgoing cap rate is always higher than your ingoing cap rate, because the buildings, they get older, they depreciate. But as you guys know, real estate does seem to go up. So usually that cap rate does get suppressed again, depending on your market, like I don't know that we can go any lower, but people have been saying that for the last 5 years. So.
Yeah. So let me ask you this: How does somebody go about? Well, two questions about cap rate. First of all, how does somebody go about finding their cap rate in their area? Like they heard us talking about Josh and you and me are all different. How do you find that out in your area?
Yeah, so I think you have to. It gets easier with apartments, but you have to compare like with like. You know, if you're looking at a 7-unit apartment, you can't compare it to a 50-unit apartment, right? You have to have something in the ballpark. So really, what you start looking at is, when you get the financials on these deals, you start looking, okay, what is the gross income? What's the potential gross income? But really, they're going to take the financials as is. And then you figure out what the cap rate for that property is. And then, so that's the income approach. And then you couple that with the comparable sales approach, right? And then comparing this type of net operating income with other buildings in the area. But I mean, I guess the short answer, depending on, it really matters who you're getting the loan from. So I think in the States, you guys call it agency debt when you get like a HUD loan or a FHA loan. Is that correct?
I heard the term, but I don't use it. But maybe.
I'm not sure.
So when you get debt from the government, basically insured, I think Fannie Mae, Freddie Mac type. So in Canada, we have similar debt. CMHCs are mortgage insurer.
Okay.
And they will
agency debt is known as an agency bond is a security, usually a bond issued by a U.S. government-sponsored agency or federal budget agency. Usually these are backed but not guaranteed by the U.S. government. Well played, Jesse.
Yeah. So just a side note on that is that was one of the things in the this is a little bit of a tangent, but in Canada, we're not allowed to walk away from our mortgages. In the States, you can. And I remember Jon Stewart on the Jon Stewart Show making a joke. We're like, that can't be true. Canadians not going to chase you down for anything. Maybe if you dropped a piece of paper there, they just wanted to catch up with you. So what happens is that when you have government insured mortgages, you're going to have somebody saying, okay, the market, we're going to value you at this cap rate. So they have a kind of a predetermined idea of what that area is going for. But I mean, from our point of view as investors, you got to do your homework. You have to just go deal by deal by deal, and you get a sense. Like I'm sure you guys know what, just through heuristics of having done this for a long time, you know what your areas are going for on a cap rate basis, right?
Yeah. And if I don't know, I'm just going to go talk to like a local broker, somebody who does know, like a mortgage broker or a real estate broker, whatever. Somebody's going to know the answer in my area. Yeah. If I don't know what normal is, and the reason, but I know that 8% is normal in my area because I've analyzed, 100 deals in the past year that are apartments or multifamilies, and I'm like, yeah, I'm seeing 7, 8, 9, 8, 12, 5.
Oh my God.
The average is right around that.
12 is just that blows my mind.
Well, you don't want a 12.
You don't want that.
You don't want that.
Yeah, fair enough. Yeah.
That's over.
It's going to cost you a lot of money.
Yeah, you can buy that for anyway.
So Jesse, tell us about the numbers on this particular property now that we've kind of divin in, and what was it about this property that actually made you want to take the leap?
So one, like I said, one of the advantages, because I am a broker, I'm privy to building a team that really I should have no business building. So what I mean by that is a mortgage broker that deals with properties that are 5, 10, 20 times more than mine, I get access to because we deal with our, buying and selling. So he'll spend some time with me. So I think building that team was really important. But for the numbers, where we purchased was I guess the best way for listeners to see it is that it's a city called Hamilton, which is about an hour from Toronto. So it's kind of like a Brooklyn to Manhattan. So Toronto being Manhattan, and kind of that's a comparison. So we saw this as an up and coming. The path of progress is going out that way. And what we found was that, everybody tries to find these unicorn off-market deals. Is it a true off-market deal? This one was not on the MLS. It wasn't on any listings. But we have software that we use for work that is basically these guys boots. It's an American company, boots on the ground guys. They call up potential owners to find these deals. And I remember calling the agent, and he was like, "What? How'd you get this number?" He's like, "How do you know this is for sale?" And I was like, "Well, is it for sale?" And he was like, "Well, depends. You can bring us an offer." And to give you guys an idea of what prices are going for. In Toronto, we didn't want to be in that market. It was too expensive. The lowest stuff is $150,000 a unit to up to $300,000 a unit. It's just, it wouldn't have been feasible. We were able to get this one at around $110,000 a unit. It was 1.2 and change for the 11 units. And it is at currently, so our strategy was to buy things that there was still a value add component. So the rents are not market, they're below market. So the going in cap rate 4.2%. But when you take these rents, and I've established a really good relationship with our property manager down there, which is crucial if you're not in your area to have a good property manager, because nobody will. You could have the best, they will not run their property like it's their own. Only you will do that. But if you manage the manager, you can have some good outcomes. So yeah, we looked at that. It was 1.2. And if we get the market rents up to where market is, I think we're up close to the double digits, which is for our areas, that just doesn't happen.
What are rents right now, and where do you think they can go?
So rents in that particular building, 1 bedroom would be $800. 2 bedroom would be $1,100, 3 bedroom would be $1,300, and downtown Toronto, 1 bedroom $1,700, 2 bedroom $2,500 to $3,000, and God, I don't even know what a 3 bedroom's going for now.
So you could potentially double your rents on this thing.
Well, that's the downtown Toronto. The upside on the Hamilton, the one that I purchased, I think we could get about 20 to 25% uptick on them.
Okay.
Wow.
Yeah,
that's awesome.
And what's that going to cost you? I'm assuming there's a plan. You're going to go and upgrade each of the units. So what does that look like?
Yeah. So, well, first off, we are meeting next week with the fire code inspector to basically. We think we can put another unit in the basement. It's a massive inefficient basement. We went in there and we saw the washer and dryers, and we were looking at all the empty space. We're like, wow, there's a lot of space here. And I mean, that's a really easy calculation, right? If you paid $110,000 per unit and you can do that thing for 50, 60 grand, you pro forma that out for 5 years, right? And say in 5 years, it's going to generate this much. How much is that money worth today? Yeah. And I mean, that's a no brainer. So, and to your point, yeah. So like I said,
but you're losing all those quarters
in the lower level. Yeah. But so to the point of the actual units themselves, like I said, because we have rent control here, if somebody moves out, God forbid, passes away, anything, you get in there and you do everything possible. As nothing, you don't have to make it the Taj Mahal, but you do everything you can to bring it up. Because I mean, we were looking, guys, the first renter that we saw that was like really under market, we were looking at it, we're like 1991. I was like, that's when she moved in. Wow. She's been there ever since. And my partner morbidly is just like, well, it should be too long. And I was like, John.
Oh, man, come on.
I'm like, come on, John. I'm like, it's possible. But yeah, so it really is for us, it's a buy and hold. This is the type of thing, because of how our market is, I can't see myself getting rid of this in 20 years. The plan would be to get the rents up, and then try to refinance in 5 years.
Okay. Got it. So talk to us about how you guys came together. You've got a partner. You guys have gone in together on this project. What does that look like? How'd you find this person? And then on the financing, how'd you go about actually financing the property?
Yeah. So like I said, John, he's one of the main guys in our apartment group at the place I work, and kind of connected because he knew I was doing this. The investing. And one thing I find interesting is, I'm sure your listeners find this too, is that you, regardless of what company you go to, you're always the outlier if you're a real estate investor, right? If I think in the States, your W-2s, right? We call them T4s, where you have a job you go to 9 to 5, and it's not dissimilar in the real estate world and brokerage. That you would think all these guys, they're all these real estate guys. None of them invest. Like,
that's amazing.
Yeah, it's not none of them. A few of them do, but it's incredible. Now, there is an argument to say that you might be over leveraged if your day job is real estate and you invest in real estate. But usually they're not that pragmatic. They just aren't exposed to it. So anyways, John and I sound like we're dating or something. John and I, so I met John.
Okay.
That's okay. Not that there's anything wrong with that. So we met, and we basically said that it was a good yin and yang.
Did you guys meet? Was it a restaurant? I mean, what?
Below our office. Yeah. Yeah. So yeah, we basically talked about what we wanted to do. And what's funny is there's a great yin and yang, is the fact that John had never bought an investment property. He makes good income at the brokerage, more than I do, and he has no debt, and he rents, and he's just got a car, I think, as his only liability. And now you go to turn to me, is I've got all this debt, but I've actually done real estate before. So the banks looked at us, they look, okay, here's a credit score of 1 billion, and here's a guy with a couple assets that we can go after if things mess up. And we kind of like balanced out into this like pretty good people to actually lend to. That couched with the fact that I think when lenders look at the fact that we're investing in apartment, and I specialize in office and John specializes in apartment buildings, it lended a bit of credibility, which I think was nice with some of the lenders. But like I said, it's really about showing the lenders what the property can do, and what, if you bring people a good deal, I really do believe that, they'll take it for what it's worth.
I love that. And just to point out something that you said there, like, a couple things. First of all, I think that's like the ideal partnership, right? Is where you might be lacking something and your partner's lacking something, but they're not the same thing, right? Like, hey, we're both broke and have no money, but lots of ambition doesn't usually work as well as I'm broke and have lots of ambition. You've got money and you got no time, or whatever, right? I'm lacking a credit score. I'm lacking cash. I'm lacking the ability to get a mortgage, whatever. But you combine that together, and then, like you said, combine that with a deal, and you shouldn't have a problem. Like, so people are saying, I don't have any money, I can't invest in real estate. Well, find somebody who does have money but doesn't have passion like you have, and make it work.
Yeah. And I got to say, I was stubborn for a long time. I'm sure people have, listeners have dealt with this before. I was stubborn for a long time to get a partner. I wanted to just do it myself. Every time I found that, I might need a partner for this, I would figure out a way to do it on my own. And then I would just do that. But now that we've kind of gotten into the swing of things, it definitely takes, it's not just the burden of the actual day-to-day operations. Even in commercial, it can be an emotional game, right? And it's nice to have just another person that's kind of battling with you. So, if stuff doesn't work out when you're trying to find a deal, you've got another person there.
Yep.
Yeah,
Totally agree. 100%. That's very cool. And so, like, yeah, I mean, obviously partnerships are not like the end all be all. Like they're not problem free, but I happen to like them a lot. Like there's just certain things that it just works better. So. Cool. So a couple more questions before we get out of here. First of all, what do you think was the scariest thing for you, like jumping into this, like get the apartment complex, like doing the 11 unit? What was the scariest thing for you?
The scariest was the first few. It's just a short story. The first building we saw was a 14 unit. We get there. John and I are in our cars, and like, it's not the best area of town. This is what we would call a C-class building, and maybe even worse. And we were looking at the stoop, and it just looked like guys were like rolling up on bicycles. The guy would hand him something and then go back. And we're like, oh, okay. I see
what
the first guy.
Doing?
I don't know. I think
Brandon,
Pokemon,
can you tell me
Pokemon's back?
Yeah, I think they were playing Pokemon Go.
What do you guys do on stoops, Brandon?
Just Pokemon Go. That's all it is, Josh.
Oh, okay. Okay.
Calm down.
With the charger.
Yeah, exactly.
So we saw that, and now we're like, geez, we got to meet this guy here. So we go to meet the owner. He starts showing us through, and he's taking us through, but he's taking us through instead of going into the first unit, like logically going up, where we go like to the back unit, check this one first, then we go up this area, and we're like, how you get that spidey sense pretty quick. You're like, something's up. And not to mention, we just saw a drug deal happen. So
that's what it was.
So
confused.
And it's funny, might be the guy that's paying the rent on time all the time.
Yeah.
So what we found out was that we left. He's like, okay, guys, so this is the last unit. Because we always, one of the rules is go to see every unit if you're going to be serious about it. And he goes, okay, this last unit, I got to tell you. And like John looks at me, and I'm just like, okay, here we go. Okay, so somebody died 4 days ago. Just want to prepare you for that because
was it still in there?
Like, yeah, no, what the reality is that if you're in this game long enough, that happens. Like apartment buildings, people pass away. There's nobody there to, it's just a reality. But the fact that it was the first apartment, the first deal, right after a drug deal, we're just like, okay, is this going to be? Should we be getting involved in these things?
That's true. I mean, on one hand, people do die and they pass away, but I can see that being a little bit scary for jumping in. All right, what about?
Then
go ahead.
We went to see. Sorry, I was just going to say. Then we went to tour the unit. I don't know, how many people would want to do that after, but it's the game we're in.
That's the game you're in.
What would you say? Well, I guess what mistakes would you say you've made in your investing career so far, if you can look back?
Well, we only have an hour here, so
you've got like 3 minutes.
Yeah. You know what? I think first of all, being more open to the idea of partnership, not because partnerships are the best thing, but they might be the best thing for you. And if you're in a situation where they are, it's really something you should think about. Number two, the biggest one, bar none, is not understanding how much money goes into these things and thinking you're cash flowing on paper and not allotting enough to repair and maintenance. I can't stress that enough.
Yep. Yeah, I love that.
Right on. Cool. Right. So what's next?
So, you know what, for us, we've kind of set up a goal after we incorporated, set up our actual business for this apartment. It's ambitious. I'd like to be at 100 units in 5 years, and that's kind of the goal right now. And we're positioning all our kind of capital right now to make a run for it. But it's tough, and you talk about scary things or mistakes you've made in the past. Right now, the scariest thing for us is how hot our market is right now. And you're always second guessing yourself. You know how the best thing when you get a deal is, you hear the best thing in the world followed by the worst thing in the world. You when somebody says, say you bid on a deal and somebody says, okay, you got the deal. You're like, yes, wait a minute. Because you don't know if you overpaid for them, right?
Yeah.
So that's the challenge right now. But I think just making sure you have a little bit of capital set aside so that, if the market goes, a certain way, that you're ready to kind of deploy it.
I'll tell you about a hot market. So somebody this morning came to me and said, hey, I was looking at a duplex in town here, and it came on the market on Sunday. We are currently on Tuesday. They said there were 17 or 27 offers on that property.
Wow.
Since that thing's come on the market.
Well, it's funny right now. I'm in my condo in kind of the east end of Toronto, and I've listed this place. And our commercial real estate market's one thing. Our residential real estate market is bananas. I listed it yesterday. I've had 3 offers and about, I think, 15 or 16 tours. I got to get out of here in like half an hour just so I can not be here.
Okay, don't worry. We'll cut this show. Yeah. Hey, Brandon. So this show's over. That was great. Yeah.
Yeah, I had to be explicit with the guy helping me out. I'm like, listen, nobody can come in at this time. Not even knocks on the door.
That would be fun.
Let's
bring him on the mic.
Bring him on the mic. Yeah, tell us what you think about Jesse's house here while live on the air. All right.
It's a really hot market.
Yeah. All right, cool. So let's shift gears here and head over to the world famous fire round.
Fire round.
It's time for the fire round.
So let's get to the questions. Number 1, when screening tenants, in addition to running a credit report, checking landlord references, and checking bad tenant databases, I also try to check the applicant's social media accounts. Let's see. I checked the social media profile to see if they had any pets, etc. Would it be okay and legal to require, you don't have to answer legal, you're not a cop or a lawyer, but would it be okay to require applicants to connect their social media accounts with me so I can get access to their social media profiles, even if they're set to private? That's fascinating.
Yeah.
That's an interesting one. I think that's a little invasive. What I would say is not being a lawyer, I think they're probably, there might be legal ramifications for that. I don't know specifically with single family housing or multi-residential for that matter. I don't know how it is in your markets, but they're very sensitive to housing and how you deal with tenants.
Yeah. And
I can't help but feel that might be a privacy issue. But that being said, for anything public, I always look up people on social media, not even just in real estate. We're in an age now where if you're going to a meeting, you'll pull up somebody's LinkedIn, see what they're all about. I think it's a tool in your tool belt. So as long as it's legal. Now, requiring them to do it, even if it was legal, I don't know if you want to start off a relationship like that with a tenant. Yeah. That's an interesting one.
Yeah.
Nice.
Yeah. I'm not sure. I've never even thought of that before. Requiring social media for to be my Facebook friend in order to apply for this unit.
It's weird. It's weird. I wouldn't even want to be your Facebook friend if you paid me to, but
I do pay you. I didn't pay you last month, and that's why you befriended me. All right, number 2.
Yeah. Okay. Next question. Coming into real estate investing, something I learned from the start is how much people dislike property management companies. Common complaint I hear is that they feel like the property is treated just as a number, or they didn't properly screen the tenants or monitor the property now that they've to repair a trash rental unit, squeezing all the profits they hope to gain. I guess at the end of the day, the question, they've got a whole flurry of questions here, but what I'll just paraphrase. What do you think are the keys to finding a good property management company?
So for me, I think you need boots on the ground in the local market that you're in. I think that's huge. The one that we ended up going with in Hamilton was a gentleman that doesn't live in Hamilton, was born and raised in the area, understands the tenants and the type of tenancies in that area. Now, property managers, I'm one that complains about them, but I'm also, when stuff goes wrong, they're the first person to get blamed, right? Because they are the front line. But I think John, my partner, said something really interesting when we were interviewing property managers, and he says, "You're the face of our company, and you're going to be a representation of our company owning this building, and we need to make sure that you're a good representation." So I think when choosing a property manager, first of all, you should always check more than one person. Don't just go with the local, Google, first thing on Google. And really, really talk to them. And then I think you have to set expectations early. One of the mistakes I ran into with the first property manager I chose about 7-8 years ago was I didn't set the expectations of how payments made. I wanted it deposited right into my account. He wanted to run it through his company. I wanted him to use my credit card so I could link it to my accounting software easier. He said that wasn't feasible because of how their system's set up. So I think expectations are really important right at the start. And then I think the last piece I would just say is communication. If you are not in constant communication with your property manager, without, bogging him down or her down, I think that's crucial. I think you really need to have, you need to be as much on the front line as they are, but not get that call at 4 a.m.
Yeah. Makes sense. Yeah. It's good.
Cool. All right. Number 3. Would you invest in a location where the population is declining? This person was talking about Chicago. There's areas of Chicago that are declining. Would you invest in a market where the population is going down?
Yeah, I think that question, it's kind of counterintuitive, right? You would think that you should be investing in population increasing, but I think there's so many variables there. I would say, why is the population declining? Is it that the population, it was overpopulated before and there's some macro reason that it is declining? So I think you'd have to go back. It's funny, every time we joke about this at work, every time there's an unknown, you got to go back to fundamentals. So every time there's, an unknown of how appreciation is going to go in a market, go back to the fundamentals, cash flow. And I think to answer that question, it would be go back to the fundamentals. Where's transit? Where's the path of progress? Where are people moving to? Are people investing? Are businesses moving there? The top, the Fortune 500 companies, are they headquartered there? I think those are all variables. It's a tough question to answer without more information.
Sure.
Fair enough. All right. Last question. What should a new investor look for in a real estate broker?
Oh, a real estate broker.
Not you.
Yeah.
Like somebody who really does it.
Really makes it rain. Just going to pretend that didn't happen and we'll just move on to the answer here. I think, it's easy for me to say, this is what I do for a living, but I would suggest to anybody that's looking for whether it's a commercial or a residential broker, that first of all, you look for a track record. I can't speak for residential. And honestly, I think guys in my industry, they besmirch the resi guys a little too much. I think they're a little hard on them. They think they're cowboys and it's not really a business. And I think there's success in every different facet of real estate. There's good brokers in every market. And I think when you're choosing a broker, it sounds corny, but I think just being transparent and honest, it's funny. We always mention at work is that, and I'm sure you guys, having met a bunch of brokers, if you looked at the most successful people that work at my company, Avis & Young, the thread, the commonality that they have is not intelligence. It's not, all the smart guys are making the most. It's a lot of times it's the likability of the person. It's somebody that you want to transact with, somebody that you feel comfortable with. So I think transparency and having a broker that's going to be honest with you is really important.
That's great. Good answer. Yeah. Well played.
Cool. All right. Well,
and you are likable, so
you
surely
right.
you're good at your job.
Appreciate that.
All right, let's shift gears one last time and head over to the last segment of our show, which we lovingly refer to as our Famous Four. All right, these are the 4 questions that we ask every guest every week, and I know you've heard our show before, so you know what's coming. Number 1, what is your favorite real estate-related book?
Okay, so there's a bunch of them. The one that I've revisited, just how you have ones on your bookshelves from when you were really young or when you first got into it. It's Landlording on Autopilot, and it's by Mike Butler. Yep. It's one that I've come back to more and more as a kind of you progress and you find new things because you're doing something different than you did years ago. But it's just all around. For the reason I picked this one is I'm thinking about the people that are maybe at the earlier stages and just want to understand what real estate investing can do. And if it's okay with you, I would just say find also books that are specific to your market. If you're a Canadian, don't really read tax books that are germane to the States and vice versa. And it's a little harder for us, right, in Canada, because there's just not as much out there. But I think there's a gentleman named Don Campbell, for my market, if guys are looking to kind of get into the market.
Cool. All right. What about favorite business book, non-real estate?
So this one here is I got these in front of me. It's called Getting to Yes. I don't know if you guys have heard this one. It's a negotiating. Yeah. So I was really fortunate. My work, a gentleman I work with, a great guy named Sean, who, if he's listening, he's having the battle of his life right now. He unfortunately was diagnosed with cancer. So we're all kind of pulling for him. We were really lucky to go to Harvard and take this 3-day course there on negotiation. And really the takeaway with Getting to Yes is, like anything else, negotiating can be learned and it can be taught and people can get better. I think a lot of people just assume that negotiators are just as good as they are, and it's part of their DNA. It's a genetic thing, and it really isn't. I think negotiating really comes down to practicing and really doing your due diligence before going into them. Yeah.
Hey, sorry to hear about your friend Sean, and hopefully he does get better. So good luck to Sean if
Thanks,
you're
Josh.
listening. Cool, Jesse. Hobbies. What do you do for fun, man?
So, like I said, I'm a big car guy. So F1's firing up again. I've kind of purchased an old tuner that I'm going to be working with this summer. And aside from that, going out with friends, I play guitar less and less as real estate kind of picks up more and more. But yeah, it's just trying to relax on the weekends. I'm about 2 weeks from finishing up a part-time MBA, so I haven't really had time to do much else.
You're not very busy, real estate investing, selling property, doing your MBA. Yeah.
Sitting around
Try to keep the calendar full. Watching the soaps.
Obviously.
All right, number 4. What do you believe sets apart successful real estate investors from those who give up, fail, or never get started, besides watching soaps?
Yeah. For me, limiting beliefs, 100%. I think people put them on themselves. I think we're not, I can't remember. There's Success Talks is a really good podcast, and we're not really wired to search for things that are uncomfortable. And I think the whole point with real estate is that it's not comfortable doing their first deal at this size. And then when you break out of that, going to the next deal. So I think one thing that's really interesting, and I'm not sure you guys can tell me if you've noticed this, that when you're listening to real estate investing podcasts, you find a common trait of all of these individuals. And it's that, the coaching trait, the success kind of backed books, the idea of not just making money, but prospering and being successful, whatever that means to that particular individual. And I think that's kind of a philosophical commonality that a lot of real estate, for whatever reason, people that kind of want to better themselves, whether it's for, your kids or just, getting to the bigger and better next deal and just improving yourself as an individual.
Yeah. No, that's great. And I do agree. I think that most of the folks that I believe to be successful in the real estate investing space are definitely folks focused on their own self-improvement, they read a lot. They're always trying to better themselves. So yeah, it's great. Yeah. Cool. Awesome, man. Well, before we let you go, where can people find out more about you? How can they reach out?
Sure. I mean, the easiest way to find me, I'd be more than happy to take, I'm always interested in taking emails from people trying to get in. It's Jesse, Jesse, Fragale @gmail.com, or you guys can go to my actual brokerage site, which is avisonyoung.com, and AVISON, Young spelled the normal way.com.
Cool. Perfect. Awesome, man. Well, thank you for sharing your story with us. Thank you for coming on. We definitely appreciate it. Great story. Lots of luck to you. And again, best of luck to your friend.
Okay, great. Thanks, guys. Appreciate it.
Yeah, thank you. See you around.
Cheers.
All right, guys, that was Jesse Fragale. Big thanks to Jesse for coming on the show. That was great. Awesome. Good guy.
It was. Yeah, he's a fun guy doing a lot of cool stuff. And even though he's Canadian, and he says...
and apparently I was the guy who was making fun of him. But
I was not done with my statement.
The second he's gone.
No, even though he's Canadian and can't say about very well. It's a boot.
I didn't notice that at all.
It still was an awesome show. I think there's a lot of wisdom I took from that. I loved our discussion about CapEx and how we buy properties that seem on paper to be good. At the end of the day, they're not. So make sure you guys are calculating for capital expenditures. And if you want help with that, a couple quick resources for you. First of all, we've got a lot of stuff on capital expenditures or CapEx on BiggerPockets. Go to BiggerPockets.com, and in the little navigation bar at the top of the page, there's a search bar. Just type in CapEx. You'll find a ton of good stuff on that. Also, if you use the BiggerPockets calculators, like the rental property calculator or the BRRRR calculator, we have a section in both of those for estimating your capital expenditures. So check that out as well, BiggerPockets.com/analysis.
I think the important thing about that conversation beyond just planning really came down to things happen that you can't plan for. Yeah. The story of your property with the fire, losing the $15,000 or whatever it was, Jesse's story, that stuff, even if you account for everything possible, even if you're conservative, stuff like that can happen. And that's really why you need some extra money. I mean, that's why you need some cash in an account that, you can't be getting into rental real estate, and using every last penny that you have in order to get in, because when things come up, you need to be able to take care of them.
Yeah. And that's why I like the idea of, there's a lot of low down ways to invest in real estate. I mean, I wrote the book on it, right? But I like the idea of partnerships more than most, because there's somebody else there that can help through those tough times. Because let's say you figure out a way to buy a property with zero money down, but if you have no money, then when those bad things do happen, you're just it can bankrupt you, right? But if you have a partner, you can weather those storms a little bit better. So again, Jesse talked about that as well, and I thought that was right on.
Yeah, awesome. Cool, man. Well, good show, good stuff. Lots of luck to you on this this new thing that you're working on, whatever that might be. And what are you looking at? Looking at somebody.
I'm not looking at anybody.
It looks like you're looking at somebody.
I'm twirling a pen. Is that what you're noticing?
I don't know. Why are you doing that?
I twirl pens whenever. I don't know if you guys notice that, but I twirl a pen on almost every podcast episode. If you're watching this on YouTube, I'm always twirling pens in my hand. That started from I don't remember. It was a movie, like an old James Bond movie or something like that, where a guy would twirl a coin in his hand. Yeah. And ever since seeing that, I would do that all the time with pens and coins and whatever. And it's just now nobody
really cares.
Nobody does. By the way,
so
my thing,
mobile homes,
mobile home parks. I'm looking into buying this year. I want to buy a mobile home park. So
wow, that's awesome.
Yeah, we'll see. Maybe
you'll
come
put
along
one in your backyard.
I might put a mobile home park in my backyard. I have actually 5 acres of land out behind me, except for 4.5 of it is
slightly hilly.
Yeah, 4.5 of it is on a slight hill, which is barely even walkable. I mean, it's a hill and full of trees. But you know what? You could have tiered mobile homes all the way down it.
That would be great. That'd be awesome. That's
I'm
a new
sure
thing.
It would be. You could live there.
Yeah. Oh, you're gonna rent out to me?
I'll rent to you.
Yeah, that's cool.
As long as you pass the credit check, which I'm not too sure about you.
All right, guys, time to go. Show 221 is in the books. Thank you so much for listening. You can check out the show notes for today's show at BiggerPockets.com/show 220. Thanks again. Until next time, I'm Josh Dorkin, signing off.
You're listening to Bigger Pockets Radio, simplifying real estate for investors large and small. If you're here looking to learn about real estate investing without all the hype, you're in the right place. Be sure to join the millions of others who have benefited from BiggerPockets.com, your home for real estate investing online.